giving to charity. Also, ethical responsibility, be ethical. Don't cause problems in society. Legal responsibility, obey the law. Don't don't break laws. And then economic responsibility, be profitable. So make profits. So it's important to we need to do all four as a company in order to ensure integrity, trustworthiness, trustworthiness, ethics, and morals. So make sure you do all of these. So I'll share this here in the chat. So that's very important. You want to invest in a company. So you want to invest in a company that meets all four of these goals. The company is more likely to be of high integrity when they meet all four of these goals. So detail these goals in your project for your company. So why is CSR important? So I'll ask the class, why is CSR important? Does a Sheik want to try? Yes. Yeah, it's important to be socially responsible as great as Sheik. Yeah. We want to make sure that yeah. So with use of social media and instant news, reputations can be irreparably damaged in seconds. Not just about risk management, deflecting negative scrutiny. So doing good, there's a lot of value in it, even when, especially when you can differentiate yourself. And firms of all sizes can pose significant risks to ecology and humans. Activities of the private sector can have a significant impact on the environment, communities, and the economy. Effectively recognizing and managing these environmental, social, and economic costs are an indicator of a well-managed company. So CSR is part of ethical leadership. Success is ultimately in the hands of consumers. Do they buy from us or not? Consumers are demanding more social responsibility from businesses they buy from. The world has changed. Consumers now demand socially responsible business practices. So these are the benefits of corporate social responsibility. I put in the chat. So this all benefits the company. So you get winning new businesses, enhanced relationship with stakeholders, attracting, retaining, and maintaining a happy workforce, media interest and good reputation, access to funding opportunities, enhancing your influence in the industry, differentiating yourself from the competitor, saving money on energy and operating costs, increasing customer retention. So all of these things are benefits of corporate social responsibility. These are, can you think, so I'll ask the class, are there other benefits of corporate social responsibility? I'll ask Maxine, do you want to try?
Repeat the question, sir.
Sorry?
Repeat the question.
Sure. So are there other benefits of corporate social responsibility?
What about recycling?
Yeah, that's good. Yeah, that'd be a good one. So recycling. That's great, Maxine. Thank you. Excellent. So recycling leading to less garbage on the roads and landfills. That's great. That's great, Maxine. Thank you. And then I'll ask Prashani, are there any other benefits of corporate social responsibility? Increased customer retention. Yeah, that's good. Yeah, increased customer retention is a big one. That's great. Yeah, excellent. So also you get a stronger brand image. So you get a better reputation. Focusing on the right CSR issues contribute up to 30% of your company's brand value. So increased customer loyalty and sales. Today's conscientious customers have more personal relationships with the products and services they buy. So they want to support responsible and worthwhile causes. And 42% of how a person feels about a company is based on their CSR approach. So also there's less costs based on lower environmental impact. So there's more profit. And then also employers like to stay with companies with good corporate social responsibility. So about 63% chose improving society over generating profit. So your corporate reputation can affect your ability to obtain venture capital, insurance, loan financing. So having a good name can ease and reduce your company's administrative burden. So you don't have to worry that as much about regulatory issues. And then activities you can do are reducing carbon footprints, corporate governance, improving labor policies, participating in fair trade, charitable giving, volunteering in the community, corporate policies that benefit the environment, and socially and environmentally conscious investments. So you need to understand, so determine what corporate social responsibility means to your company and how it relates to your overall business mission and purpose. Look at what your company is doing in terms of corporate social responsibility activities. So it maybe you're already following all environmental regulations, and also you may be contributing to charitable causes and reducing waste. Also, research what corporate social responsibility issues are most significant to your business. Look at online lists and determine the corporate social responsibility or sustainability reports of larger companies in your industry to see which issues they're tackling. Then prioritize and identify which corporate social responsibility issues are most important to your customers and stakeholders and deal with those first. Engaging with your employees and customers is a great way to get going and to gain support. And then participate. Your CSR strategy has to become more part of your overall business strategy. Don't think of it as part of your business, but rather the way you do business. Identify opportunities. So having good corporate social responsibility can lead to entering new markets, developing niche products, and forging strategic partnerships. Connect, communicate your CSR activities to your various target audience through many channels as possible. So what happens if a company trades or ships products that could be environmentally harmful? Does Sithumini want to try? So the problem is there's issues with society. So it will be bad effect to the environment, also the reputation of the company. Yep, exactly. So that's very true. So yeah, society will have issues with that, and it's bad. So uh, Enron had about 20,000 staff and $101 billion in revenue during 2000, and Fortune named Enron the most innovative company for 6 consecutive years. So in 2001, what happened was they made up accounting statements. So their accounting statements were not real. They made up the numbers. And Arthur Andersen, who was supposed to check those numbers, they used to be an accounting firm. They used to be one of the accounting firms alongside Deloitte, KPMG, EY, and PwC, but now they don't exist anymore because of Enron. They lied about saying that Enron's financial statements were correct, even though they weren't, and that's what brought them down, and they lost all their business. So there was a $700 million net earnings disappearing, $1.2 billion of equities that disappear from shareholders, and over $4 billion of hidden debt. So they hid debt in companies they owned. So they owned a whole bunch of other companies and they shifted the debt to those companies. Then a lot of their assets and profits were inflated or totally fake. And debt and losses were put into companies that they owned that were offshore and not part of not part of Enron, but they were owned by Enron. So they hid debts in those companies, and that's why it wasn't in their financial statements. So Ken Lay and Jeffrey Skilling, they went to prison. So Ken Lay, he was found guilty and he passed away right before he was sentenced. Jeff Skilling went to prison for it was almost 20 years. He went to prison for the Enron situation. Andy Fastow was the person who put together a lot of the accounting that for Enron, and he falsified documents, made accounting statements that were fake. David Duncan was Arthur Andersen's chief auditor for Enron, and he took part in making fake accounting statements. And Arthur Andersen should have let everyone know that Enron was making fake accounting statements. They should have let everyone know about that. They should have let the government, they should have let the public know, but they didn't. They participated in the fraud with Enron and stated that Enron's accounting statements were true, even though they weren't, and that's what brought the company down. So then Sharon Watkins was the whistleblower who let a lot of what happened with Enron out in the public. And yeah. So yeah, you need to why we're covering corporate social responsibilities because if Enron was a corporate socially responsible where they had ethics and morals and followed the laws, if they followed the laws, followed ethics, followed morals, they would not have this issue. So they should have not lied about their accounting. If they didn't lie about their accounting, there wouldn't have been any issues. So Enron, if Enron didn't lie about their accounting, they wouldn't have had these issues. So it's very important to when you're looking at an investment, just determine if they're lying. If they're lying about their accounting, then don't invest. So just do your research and determine if they're lying about their accounting. Then there were issues. Citigroup and J.P. Morgan Chase worked with Enron. Enron was a very lucrative investment banking business for the banks, and then the banks lent money to Enron, and they should have known. They should have questioned Enron's accounting practices, but they didn't. So the problem was regulation. So they didn't have enough regulation in the markets that Enron traded in. So that was a big problem. They should have had some regulation to prevent this, but they didn't, which was unfortunate. They needed some sort of regulation to prevent what happened with Enron in terms of accounting regulation. And they needed corporate social responsibility. Like if they were socially responsible where they followed ethics, morals, and laws, this wouldn't have happened. So they should have not lied about their accounting. So what happened to the employees was thousands of employees lost their jobs and retirement savings. The pension fund for the employees was obliterated. The company, yeah, so more than half the employees invested $1.2 billion in Enron stock. Those shares are now worthless. The Yeah, so people lost their life savings investing in Enron. And then the government created Sarbanes-Oxley Act, which was used to ensure that accounting was not fraudulent in the future. So the Sarbanes-Oxley was created in order to prevent falsified accounting statements. So Sarbanes-Oxley was created to prevent Enron from happening again. But you still have to be very careful. So with your investments. And yeah, they needed more compliance standards to determine if accounting statements were fake. So to audit accounting statements and prevent this from happening. So the president at the time, George W. Bush, in 2002, signed Sarbanes-Oxley into law, and this heightened the consequence for destroying, altering, or fabricating financial documents and defrauding shareholders. So they created the Public Company Accounting Oversight Board to prevent these frauds from happening and inspecting public accounting boards. So yeah, this needs to be prevented from in the future, and you can do this through being very careful with investing and making sure that the companies are not faking their accounting. And so lessons learned from the Enron scandal uh, are that accounting cannot be falsified. You need to be very careful with investing. You need to determine if the company is lying to you.